Okay, good morning, everybody. Welcome to our Thursday discussion. Glad to see there's a lot of people in already. We're going to kick off earlier than normal today. We normally wait 1 or 2 minutes, but we've got a lot to cover in that we want to be talking about 2 companies today because we've prepared a note on Redefine, and also there was some news on Richmond, and seeing that Fisokuhle is the analyst who does both these companies for us, and we've got him, we figured we might as well talk about both. So we're going to be talking about 2 different companies. One that gives us stuff like Centurion Mall, South Coast Mall, East Rand Mall, and a couple of office blocks in Sandton. And then secondary, the Mr. Rupert's company, being Richmond, who does luxury watches, Daniel, Cartier, Panerai, and so on. So Fisokuhle, without ado, carry on and give us your take. I'll run the slideshow for you, and then after you will hop into Shaun's technical view on these 2 stocks, and then we'll take questions afterwards. Thanks very much, Fiso.
All right, thank you, Sarel. Good morning, everyone. My name is Fisokuhle Mbutho, and today I'll be taking you through some of the highlights for our Redefine Company Update Report. We'll just talk a little bit on the summary, the thesis, the thoughts, as well as some data points, touch on the valuation, and then Shaun will do the technicals and we'll do the Q&A. So just on the summary side of things, we maintain our buy recommendation with an intrinsic value of 460 and an upside of 18%. And our thinking there is split into 3 parts. One concerning the balance sheet, we're talking about interest cover and gearing having remained stable over the last 4 years. I know it's been a high interest rate environment, and property is typically a highly leveraged business. So interest cover starts becoming a lot more important, and control of gearing starts becoming important as well. Second part is correlation to bond yields. Those are providing a base for upside potential. Is the slide I'll show as well, showing that thesis coming into play, where what we expect is an easing of bond yields. Should see property performance, should see an upside in property performance across the sector, and particularly in Redefine here. And then the last part just being property fundamentals. We expect those to continue to improve from a rental reversion side as well as from a vacancy side. And then in terms of just what will really change our minds, that would be a change in view of bond yields from decreasing to increasing, as well as a deterioration in those property fundamentals. Sorry. Just on the relationship of bond yields.
I'll see if I can mute there. Sorry, please. So carry on.
Just on that relationship to bond yields. So the chart at the top is more so to illustrate what has happened from our previous company update report, which was around August, and at that point, the bond yields were closer to their 3 standard deviations from their long-term averages, and you'll see there on the green. On the top chart on that green dot, the latest data point is where we sort of see that thesis coming into play, where the easing of the bond yields is seeing a bit of an upside in the property performance, and in this instance, particularly Redefine. And then the bottom chart, just to illustrate it as well.
Sorry, Peter, that was me. I was just trying to get rid of the background noise.
All right, no problem. Thanks, Vaughn. And then just on the bottom side there, to highlight a little bit from a valuation perspective as well, we're showing that relationship between the bond yields and the price to funds from operations multiple, where we also did see a similar trend there, where the easing of the bond yields saw an uplift in that in those multiples. I'll just jump to the next one, Sarel. Just to sort of highlight why we think we can expect those bond yields to come off a little bit more, is when you're looking at the top chart there, it's headline inflation and core inflation as well within that target inflation range by the SARB of 3 to 6%, as well as, excuse me, this is general anticipation of those interest rates to come off, and when they do, the impact will be a continuing easing in those bond yields, and then a consequential uplift in property performance. One part of our thesis. And then just to speak a little bit of gearing and diversification, one of the reasons why we like Redefine is its gearing looks to be on point and it's diversified quite well. Just on the loan to value perspective, you can see that over the past 5 years, it has decreased a little bit and maintained it quite nicely. Excuse me. And then just on the interest cover ratio part as well, sort of a similar story. We did see a bit of a downward movement from 2019 to 2020, but the interest cover ratio has typically stayed above 2 times, which is a rule of thumb, which is good for us, speaking a little bit to the strength of Redefine's balance sheet. And then just on the far right there on the segment split, you'll see the reason why I wanted to add this here to sort of emphasize that it is a diversified company and it does have exposure to office properties. But the important part here is that the important part is split into 2 parts. The first being the kind of office asset exposure that Redefine has is primarily P grade and A grade office space. And the second part is they are going through a strategic disposal program to let go of some non-core assets all around the segments, but particularly in office as well, since there has been a sort of a structural change in the kind of office space that is being demanded in the market at the moment. And then just at the bottom there, starting from left to right, I've got those retail vacancies. So what's important to note there on the 2023 line is that there was a bit of an uptick of about 2%, but the reason that has happened was because of the consolidation of motor dealership space that opened up. But the commentary from management there is that because that kind of space is no longer part of Redefine's core retail offering, they are expecting to sell that as soon as possible. So typically the way that we would look at it is that and the 2023 number actually should be closer to about a 4% level, would be a stabilizing of those retail vacancies. Similar story with industrial vacancies as well. One of the reasons for that uptick was primarily driven by a movement of, I think it was an Isuzu outside to a different location. We saw that uptick there, and the guidance from management was that they expect to have that vacant space filled up by during FY24, and then office vacancies beginning to stabilize. I could just jump to the next one, Sarel. So I added these 3 charts here just to contextualize a good picture of where demand is going for these type of 3 property spaces. On retail reversions, a similar trend across all the other property guys that have retail exposure as well. The retail reversions are moving closer towards positive territory. You're seeing increased foot count as well. So the demand is definitely improving. And it's a similar story with industrial reversions as well. Those ones have been improving for much longer period, typically because the industrial has been the better performing asset type out of the 3. And then just on the office side, on the office, the big commentary there is the office reversions have started to become a little bit more stable. Redefines is a little bit on the better side compared to the whole office sector. But the trend there, even across vacancies across the sector, is that there's beginning to be a stabilization of these fundamentals. And the important thing to note here again is the kind of office space that Redefine has, primarily P and A grade office spaces, as well as their disposal program to concentrate more on those better assets. So when you combine all those 3 points from our thesis with the balance sheet, the correlation to bond yields, as well as the improving property fundamentals, what we do expect is a bit of an uplift from a price to funds from operation multiple perspective, which has informed how we've implemented the multiple into our valuation, resulting in our intrinsic value of 461 and that upside of about 18%. And I think that's it from my side. I think we could just jump to Shaun's technicals.
Yeah,
or is that going to be?
I see you struggling. Let's go to Shaun for the technical on Richmond. Then you grab a glass of water, and then we'll carry on with Richmond after. Right.
All right.
Okay, Shawnee. So if you'll do Redefine for us.
Yeah. Good morning, everybody. I hope you can hear me. Yeah. So you can see the share price of Redefine there. It's trading far above its 21 and 40-day moving averages, as well as its 200-day moving average. And I could do every week, just calling the trend. So the medium and long-term trend, I'll still call it bullish. And you can also see there that the share price has recently rallied strongly above that resistance level, around about that 4 rand level. As Piso said, now our intrinsic value is about 460, so it's way up higher. It's about 18% higher, hence the buy recommendation. But saying that, there's also a further long-term resistance level even at 540. We could expect some profit taking after this nice little rally. And we can see that by the MACD indicators oscillated at the bottom there. MACD as well as the stochastic are both trading in overbought territory, but there's not giving any clear bearish signals yet. So on the downside, if the share price does pull back, it could retest that previous resistance level at 4 Rand, which will now act as this new support level. And if that doesn't hold, we could expect it to pull back to about 370. Yeah, so that is a Redefine, a nice little stock.
Okay, thanks, Shaun. Yeah, certainly running nicely above that resistance level. If you're looking at it from a practical point of view, what Shaun is saying is if there's profit taking, then it could possibly pull back to that resistance level, but that would be a fantastic buy opportunity, seeing that we've got an intrinsic value that's way higher. And it has now broken a strong resistance level, which is indicative of the thing gathering strength. So bear that in mind with Redefine. I'm going to hop back to the presentation, and I'm going to take us to Richmond and go back to Fiso. Fiso, you can take us away on Richmond. Thank you.
All right, thanks, Sarel. So I'll just take you through some of the highlights from our Richmond report. So I'll just start on the summary to categorize our thinking, emphasize on the geographical revenue splits, touch on those 3 areas, touch on the valuation as well. Then we'll go to the technicals on the Q&A. So just on the summary side of things, we have a sell recommendation on Richmond with an intrinsic value of 2,228 and a downside of about 14%. It ran a little bit post the release of the report, so that downside is closer to about 19-20% now. And our main concern here is the 3 main regions of operations, which is the Americas, primarily the US, Europe, and then we have Asia Pacific, which is primarily driven by China. Just from the American consumer side, so what we're seeing there is signs of a more conservative spending and pressure on discretionary spending, and we mix that with the macroeconomic data as well as commentary from Richmond from their latest reports release. That what we're seeing is that the American consumers choosing to spend a little bit less abroad, which has impacted Europe's performance. They're spending a lot more domestically, but can still sort of see that there are impacts of signs of a weakening consumer in that region. Then just from the European side, what we're seeing is that the domestic demand in Europe is not enough to fill that void opened up by the Americas pulling back on abroad spending, which continues to indicate that there is a bit of an issue of demand, and I'll highlight that in some of the charts in the future parts of the presentation. And then just on the Asia Pacific side, lastly, there what we're seeing is some loss in momentum post the reopening of China, as well as some demand concerns being highlighted by the deflation in the region. So you can sort of see that those 3 consumers don't paint a really good picture in terms of demand, which skews the risk for us more so to the downside, hence our sell recommendation on the stock. And then just the things that would change our mind would just be improving performance within those 3 regions. So I just want to spend a little bit of time on this slide because it emphasizes the importance of these 3 regions. I mean, when you combine all 3, their contribution to revenue is just above 80%. And when you're looking at that chart on the far right there, what I wanted to sort of emphasize is there were 2 stages of call it relaxing of COVID restrictions. We'll see it in Europe and the Americas first in 2Q23, where there was a spike in performance. But ever since then, there's been a slowdown in growth and slowdown in momentum. And you can see it in the numbers. You can also see it in the management's tonality when they speak about these 2 regions. And you get a similar tone and a similar picture from Asia Pacific as well. In 4Q23 and the first quarter of 2024, where there was a bit of a spike post that reopening, but that has slowed down significantly in those last 2 quarters for Richmond. Could you just jump to the next one, Sarel? So just to paint a bit of a picture for the American consumer, so what we're seeing there is they're saving less, they're spending more with low consumer confidence, and we're seeing growing credit card delinquencies. And when you just go back to that, Sarel. And when you contrast that with the commentary from management, what we're seeing is that the consumer has less cash flow in their pocket, so they're saving less, but they're continuing to spend more, and then expenditures coming a little bit through credit cards, which are also seeing a bit of a decline. a bit of an increase in delinquency. So you start to be concerned about the spending habits of the consumer and the availability of free cash flow of the consumer. And you sort of see that in the slowing momentum in performance in the American region by Richmond's results. You can just jump to the next one, Sarel. So on the European side, it's affected by two parts. The first part being the American consumer spending less abroad, and the second part being lower consumer confidence, slumping growth, climbing savings, as well as domestic demand overall, taking a big drawback in Europe, as we've seen in the latest results, as well as a trend over the last few quarters as well. You can see that the European consumer confidence has been lower than pre-COVID. GDP growth has been slumping, and an important thing to note there from the house savings rate perspective is that they're saving at an alarming rate, closer to that 2008, 2009 period, where we're starting to see that they're becoming a lot more conservative and cautious about how they're spending, hence the decrease in domestic demand for Richmond products from the European region. You can just jump to the next one, Sarel. Then from Asia Pacific / China, the commentary from Richmond and one part is that domestic travel is a big contributor to growth in the region. And what they've seen is that 91% of domestic travel is at 91% of pre-COVID levels. So you can sort of see that the runway there has shrank quite a bit. And then in terms of the momentum for demand, you can see it slowing down very significantly through the deflation in the region, the slowdown in the retail sales. And then you've got that GDP growth, which is showing signs of a little bit of movement, but it's not enough through the stimulation of the total social financing as well. And then you got the China consumer confidence at very low levels. So you can sort of see that the picture being painted there is that the consumer across all these three regions is causing a bit of concern from a demand perspective, which leads us to our valuation, where considering these three risks, it does skew everything to the downside and has informed how we apply our multiples on our valuation, where we ended up with that 2,228 intrinsic value and the 18% downside on Richmond. So we expect those valuation multiples to remain subdued because of these demand downside risks that we anticipate to see.
Okay, thanks, Fiso. Let's jump to Shaun. Shaun, if you'll do Richmond for us.
Yeah, cool. Very similar charts in the sense that also in medium term and long term bullish. It also recently broke up above that long term descending resistance trend line, and obviously it also confirms a change in trend to bullish. Saying that again, it's testing resistance at about 2,866 Rand level. Again, it could be pulling back on profit taken soon with the MACD indicator and the stochastic also again being in overbought territory. But I would suggest wait for the stochastic cross below that 80 level to give a sell signal. So I would suggest use the breakout below that short-term ascending support trend line as a trigger to sell. And as we said now, it is trading at quite a premium to its net asset value of 2228. And hence the sell signal. We could expect the share price to pull back to that previous support around about 2,600. Which is close to that 200-day moving averages and all that. Well, all those moving averages were. Again, if that level doesn't hold, it could pull back a bit lower, but still way above our intrinsic value. So yeah, that's how I see the chart right now.
Okay, thank you, Shaun. Thanks very much. Thank you, Fiso. So we've got two very different companies here. We've got one where we have a buy signal in the property sector, where we definitely see an uptake in office space, and or a stabilization, like Fiso called it. And on the luxury goods side, I mean, we always try and understand what the companies do and how they make their money going forward. From personal experience, I mean, my luxury watch is lying in my safe. I'm wearing my fitness tracker. It works better than my luxury watch because it also gives me the distance to the green on the golf course. It's just so much better. So I don't know if luxury watches are going to get much traction, but then again, We had a look at what the consumer looks like across these regions, and definitely the consumer is under pressure. But the rich will stay the rich, mate. They'll still buy these things. So I think the future for the company is not uncertain. It's just a matter that the valuation may be a little bit high, and this last bit where it ran up almost in a straight line is probably not warranted, and we could see a firm pullback to those intrinsic levels that Fiso has highlighted. I'm going to hop into Q&A. I'm going to see if there's anybody on the chat, and then we'll deal with that. Otherwise, if you want to speak, just put up your hand or put on your mic and then ask your question live. Clive says, thanks for the presentation on the two companies, Fiso and Shaun. I don't see any other questions. It looks like 2024 has dried up all the questions. Last year, we had some lively discussions, and this year, nobody wants to talk to us. So we're feeling a bit unloved, guys. We go to great lengths to bring you these presentations, and I know it's a bit technical, but I mean, there's no such thing as a stupid question. Please ask it. We can all learn from it. Bobby says he's still on holiday. Bobby, you're very lucky, mate. January is gone. We're in February already. It's time to move. Christmas is coming. Clive says times are very tight, Sarel. You can still ask questions. They're free, Clive. All right. It doesn't look like there's any questions. Fiso, you covered it. I think the long and short of it is Richmond is overvalued at the moment. We can't explain that steep rally that it's had in the last couple of weeks. Maybe a consideration to take a bit of profit there, stick a couple of bucks into Redefine, and then wait for Richmond to pull back before you get back into it. So that's the long and short of it. Fiso, thanks for helping us today. There is a question. Bobby's question is, we are buy and hold mode. Yeah, if you're on buy and hold mode, then I suppose Richmond's still good. But with a possible 20% pullback, it may be, like Shaun said on Redefine, it may be time to take a bit of profit off the table, especially in the light of this last while's steep rally, and maybe try and get in at a lower level. But if you buy and hold and you've got certificates in the drawer still and you haven't dematerialized them, then you just sit. That's what a lot of clients do. And I mean, that's what's created wealth over a long period of time. So these chats that we have, to reiterate, are also not short-term punts we're dealing out here or handing out. It's long-term research. It's for consideration in a portfolio and typically a buy and hold portfolio, Bobby. So you're right. Richard says, thanks for the presentation. What are you expecting in the budget that could affect stocks? So I think what we should do, Richard, is I'll see if I can get Adrian or somebody to have a chat with us next week about the budget and so on, and then we'll take it from there. See if we can get you some expert insight and not just my 10 cents. Eugene says, would you go short on the Rishis? It is at a very strong resistance level, Eugene. You obviously being a short-term derivative trader know what the risks are. But yeah, the fact that it is at such a strong long-term resistance may warrant a bit of a short-term punt here. Don't see anything else popping up. If that is that, thanks very much, guys. Have a fantastic Thursday, and thanks for joining us today. Keep well. See you next week. We'll be talking Renogen, the Free State's hope in hydrogen. Okay, thanks. See you next week. Ciao.